Hi, everyone. This is Jason Briack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's actually one of my favorite guests. I love having deep conversations about natural resource stocks, commodities with him. He is truly a world-class expert. He has decades of experience and success financing hundreds of mines. He's a former vice president of Sprott. He's worked in the natural resource industry for many years, financing mines, and as a credit analyst. Rick Rule, thank you for joining me again.
Always a pleasure, Jason. Thank you for having me back.
So, Rick, we're recording this interview on Wednesday, February 7th, 2024. The paper gold price is still above $2,000 an ounce, but you wouldn't know that with the gold mining stocks. I was listening to a presentation from your friend and Ross Beatty, who I've also interviewed in the past. And Ross has a lot of success, just like you, many decades of success in natural resources. And he was talking about the disconnect or divergence between the paper gold price in US dollars and gold stock valuations, like with the cash flows that these companies can produce. Have you ever seen this type of disconnect or divergence between the gold price and gold stock valuations in your career before?
Twice. Both, by the way, as preceding a major rally. What's unique this time is that the divergence really extends all the way up through the value chain to the majors. I've seen the juniors, frankly, more oversold, but I have never seen the divergence reach as high up the feeding chain as it happens now. Now, Ross, because his background is from an issuer's point of view, he thinks that the cost of capital to the gold mining industry is tragically high. Because I'm a check writer, my point of view is different, which is to say opportunity is, for me, the cheapest it's ever been. So what he sees as a bad thing, I see as a good thing, because the price of opportunity has come down. I think an interesting and related topic, Jason, is to speculate perhaps on why this is the case. And I have perhaps three whys. The first why would be that it's really been 40 years since anybody had to truly concern themselves about inflation, really since 1982. The consequence of that is, despite the fact that the hallmarks of inflation are in front of us, concern about inflation has been dampened by 40 years of benign economic climate. And people who are concerned about inflation believe that they can adopt the Warren Buffett approach, which is to say, buy world-dominating companies that have pricing power, and those companies can fight inflation internally on their own balance sheet rather than by holding gold. And there's a certain attraction to that theory if you are as smart as Warren Buffett. Sadly, I'm not. The two other reasons for the disparity, I think, are also of interest. The first involves the junior miners, which are really, really, really oversold. But I would suggest to you, Jason, deserve to be oversold. It is my belief that of the 2,500 public companies worldwide that purport to be mining companies, probably not more than 10% are viable. The rest are destined to descend to their ultimate net present value, which is to say zero. This disguises the fact that 10% of the issuers are of such quality that they add legitimacy and occasionally luster to a sector of the economy, which has no other redeeming features. If you are going to participate in the juniors, if you're going to be seeking alpha relative to the gold market generally, you have to be a stock picker. If you buy the sector, you go broke. If you buy companies, you can do well. Which finally brings us to the seniors. And I would suspect, too, that the lack of institutional following for the seniors, in many cases, goes all the way back to the decade 2000 to 2010. Jason, some of your older listeners will remember that during that period, the gold price advanced from $256, I think it was, to $1,850, more than a sevenfold increase in the gold price. Yet the free cash flow per share of companies on the Philadelphia Gold and Silver Stock Index actually fell. It took real skill for an industry to turn a sevenfold increase in the selling price of their commodity into reduced free cash flow. What all that means is that the industry has, in some senses, earned the low reputation that it enjoys today. From my point of view, that's lovely, because the lack of attention that the institutional investors played in that decade is a thing of the past, which is to say the mining companies are held to a much tighter leash. And the managers, without exception, that presided over that deterioration in shareholder value have been thanked and excused. And there are new managers who have cut their chops in times that were substantially less generous. And I expect that the performance, the fiscal performance of the gold mining industry in the next 10 years will be markedly different than it was in the past. And I believe, too, that despite the fact that people are unconcerned about inflation, that real, true core inflation is much higher than other people think it is, and that the period we're in now resembles more closely than any other the period 1969, 70, 71, and 72. 4 years where the specter of inflation was in front of us, but because nobody had been bit by it for 20 years, nobody cared. It wasn't really until the middle part of the decade of the 1970s that the reality of true inflation caused the inflation narrative to bite the investing public, which is precisely what I think is going to happen. Sorry, Jason, for that very long answer, but you asked me a fairly nuanced question.
Yeah, we're at a unique spot here. I mean, the earnings and the quarterly earnings coming up for a lot of these gold miners, especially the lower cost ones, say like your Lundin Golds, your Agnico Eagles, they're going to be very, very good, Rick. You don't expect any surprises where the costs are going to spike. I mean, the profit margins, their free cash flow should be very good, right?
I do expect some negative surprises, frankly, because we're seeing inflation in the value chain. We have been in a period of $1,900 to $2,000 gold for 6 or 7 months. And while the gold price has stayed static, the input costs have not stayed static. Particularly the cost of skilled labor has been rising at between 15 and 20% compounded for some period of time. But other inputs too, steel, cement, in certain jurisdictions, labor. And unfortunately, the input, if that's the right phrase for it, that's climbing the fastest worldwide is social rents. The increasing off-site capital requirements on mining companies, the taxes and the royalties. So I actually suspect, Jason, that there will be some negative earnings surprises.
Well, I mean, you had the mine shut down with Franco Nevada, and I was going to ask about that later. So let's save that for a little bit later. I want to add to some of your points here. Also, let me add that I think globally there is currency debasement problem relative to the US. It's a lot larger. And the demand for gold, it's not for gold stock. So there's a big disconnect. There's enormous demand for physical gold and gold tonnage from non-G7 central banks, private sector demand in China, India, Turkey, a lot of emerging market countries where the currency debasement on a relative basis is much faster than in the US. We see this in mainland China, Rick, where I believe even a couple months later now in Shanghai, I think the premiums are still up 10% above spot prices. I'm hearing, I spoke to a source that was buying gold in Shanghai at a bullion dealer in the last week or so. He said that the premiums are still over $2,200 an ounce, but they're not buying gold mining companies. They're just buying physical gold.
The point that you make is very accurate. There is strong physical demand for gold outside the United States, led until very recently by central banks that came to understand that they needed a medium of exchange that wasn't the US dollar. A medium of exchange that couldn't be politicized extraterritorially. It is also true that while the gold price has been static in US dollar terms, the US dollar has done well against other currencies. And the consequence of that is that gold has been performing extremely well in non-US dollar jurisdictions. It is true, too, apparently, that retail demand for gold continues strong in China, not least of which because of a 1,000-year-old cultural predisposition to gold. I think, however, that gold needs to do well against the US dollar for gold truly to do well. Well-heeled investors on a global basis have access to US dollar denominated savings and investment products, be it the S&P 500 index funds or be it US treasuries. And they have been schooled for 40 years to buy the dips in US dollar denominated instruments. It is also true that the U.S. by itself comprises between 22 and 23% of the global market for savings and investment products. And the market share of gold in the United States is less than 0.5%, which is to say, less than 0.5% of the assets of all savings and investment products in the United States are gold related. The 4-decade mean, Jason, mean market share of precious metals and precious metals related investments is 2%. I happen to believe in the US market that the market share of precious metals and precious metals related assets will revert to mean. If I'm right, I may be, I may not. If I'm right, demand for precious metals and precious metals related assets will quadruple from 0.5% to 2% in one market that controls 22 to 23% of the global savings and retirement assets. And by the way, one of the characteristics of the U.S. market is that much more of the market share of savings and investment assets are private rather than in government control. So it is, as you say, one market among many, but it is the most important market by every metric.
Well, right now you have a lot of flight capital that's leaving Chinese stocks and Chinese real estates. It's gone into Mag 7. It's gone into S&P 500, flight capital out of China. It's gone into physical gold, like we said earlier. Also, a lot of young adults here in Western countries, a lot of them, they don't seem to be interested in being diversified. They want to seem to just try to buy Bitcoin every month with dollar cost averaging and get rich. And then on top of that, you have the Federal Reserve Bank keeping short-term interest rates higher at around 4.5%, at least for now. There's no rate cuts yet, although maybe in a couple months when more of the regional banks go bust or they start doing some type of bailout with a new Fannie Mae or Freddie Mac or something like that, that'll change. But if you're a SEC accredited investor and you have $5 million or more in a bank account, you can earn 4.5%. Now, there's no incentive to go and take a lot of extra risk, maybe with some of these gold stocks that are not consistently profitable.
You've said a lot of things, so
I just highlighted a lot of the macro stuff. I mean, there's a lot of stuff going on in China right now.
Let's unpack a few of those things. What you say with regards to the alleged competitiveness of other savings products, including demand deposits, is very true. I myself have large US dollar savings, not because I consider 4.5% attractive, but rather because I think that there's a possibility, perhaps a probability, of some form of liquidity crisis coming up. And if I have the cash, I have the tools and perhaps the courage to take advantage of that circumstance rather than being taken advantage of by it. A lot of sophisticated investors that I know and a lot of family offices are maintaining large cash balances because they think that we might be headed into some event, not unlike the 2008 event. I'm not saying it's going to happen, but I'm not saying it isn't going to happen, and I'd like to be prepared for it. What interests me is the widespread belief among audiences, including probably yours, Jason, that the rate of inflation is correctly measured by the CPI. I don't believe that to be the case. The CPI, the so-called Consumer Price Index, in the first instance, it's a, quote, hedonistically adjusted index, which is to say that the index arrangers arbitrarily assign value to certain products, like computers and apartments, that have nothing to do with the market. But in particular, the CPI doesn't include tax. The tax is the largest component of the cost of living for most American and Canadian families. When I attempted, albeit inefficiently, to construct an inflation index in the basket of goods and services that I consume, and I'm loath to describe tax as a service, but we'll leave that aside. When I looked at the components of my cost of living, what I discovered is that the basket of goods and services which I consumed was escalating in price at about 7% compounded. The consequence of that, I think, is that although the broad paradigm is that inflation is at 2.6 or 2.7, the true inflation, the deterioration of the purchasing power of American savings and wages, is decreasing at 7%. You need to understand then that if you feel complacent with your money on deposit at 4.5, what's actually happening to you is that you're losing 2.5% of your purchasing power a year. I'm willing to do that with some of my cash because I consider the foregone interest or the negative real interest to be an option premium to enable me to have the cash to take advantage of a liquidity decline. But I would argue precisely, Jason, that this negative real carry, the difference between nominal and real interest rates, is a circumstance that reminds me of nothing so much as the early part of the decade of the 1970s, when all of the hallmarks of inflation were present, but where investors and savers had been preconditioned by the 50s and 60s, very benign climates, not to fear inflation. It wasn't really until the Fed pivot in late 1975 that the broad perception of gold as an inflation hedge and inflation itself as a real risk became widespread. And I think that's likely to happen in the US in the next 5 years, sooner if we have a real Fed pivot.
So we have a lot of these mid-tier gold miners that are producing and one asset gold miners. So these are like junior producers that maybe have a growth project that they can invest in. They don't have to go out and do an acquisition. They're selling at 30% to 50% discount to net asset value. So that's net present value, future discounted cash flows for our listeners who are not familiar. Do you expect some of these larger senior producers like a Barrick Gold, are they going to run the numbers and see that like we can go buy a producing mid-tier gold miner with a good project for a 30% discount or maybe even 50% discount in net asset value? Do you expect then a lot of mergers and acquisitions to pick up in the next 12, 18, 24 months?
I do, but I don't expect Barrick to be the acquirer. I expect Barrick to be the acquirer of very large, probably politically challenged deposits, but deposits at any rate with in excess of 5 million ounces of in situ recoverable reserves and resources. I think we'll see mid-tier lateral mergers. I think we'll see multi-asset producers, which are viewed in the market as safer and thus having lower cost of capital, acquire the single asset producers. But I think we'll likely see an orgy of M&A if the capital markets don't improve. If the capital markets improve, understand that the managers of companies that would otherwise be acquired are loath to sell, because that ends their salary stream.
The industry doesn't seem as a whole very counter-cyclical. I mean, a lot of the CEOs don't like doing acquisitions towards the bottom and when valuations are cheap. I think they're kind of more of a herd mentality and they like doing acquisitions when metals prices are ripping and share valuations are higher.
That's correct. That's absolutely correct. I mean, understand that an industry which was rewarded from a 7-fold increase in the commodity price with a decline in free cash flow is not necessarily an industry that attracts the best and the brightest.
Yeah, I mean, I'm looking at SSR Mining and they don't have a balance sheet problem. They have a couple producing mines. Maybe the market doesn't like the perceived geopolitical risk in Turkey, but they have good earnings, free cash flow, relatively low cost. They just bought a stake in Hod Maden. They have cash flow from another mine in Turkey. And yet they're selling near 50% discount to net asset value and they're mid-tier producers. So it's kind of surprising to see valuations like that.
I think the challenge there is that the discount rate that they chose to use is 5%, which I think is too low. I think the other challenge that Silver Standard has is that the mines that comprise the net asset value are viewed by the mining industry as being mines that are very long of tooth. Mines that have produced for 25 or 30 years. So the potential for downside surprise and the lack of potential for upside revaluation in these mines is probably reasonably low. The upside in SSR, from my point of view, is all around Hod Maden, which I think is a superb deposit. And it's a deposit that has suffered, I think, from a lack of regional exploration. I believe, and there's some dispute about this, I believe that Hod Maden is a volcanogenic massive sulfide deposit. And without going into boring detail about what that means, it is common in VMS deposits for them to occur in clusters. And I don't think that SSR or their partner, their Turkish partner, Çelik, has done very much regional work. Their belief is that they put the thing in production, they pay back the construction expense, including the mill, with free cash flow from the original deposit, and then they drill out the surrounding grounds from free cash flow, which I understand. But I suspect that the real upside surprise at SSR, if it occurs, will be around Hod Maden, not the other assets.
And that's how the industry does it with once a mine gets to cash flow positive. We're going to see that, I think, with Greenstone too, up in Canada. Greenstone, the construction just finished. But with Hod Maden, I mean, there's the grades for the copper. I think they're some of the best in the world. And the deposit, the mineralization comes up right to the surface. So there's the potential there for near surface mining. And once the deposit's in production, I think they're gonna reinvest a lot of the exploration drilling. The copper grades, though, and we're gonna need a lot more copper long term with the amount of electricity artificial intelligence might use. The copper grades are some of the best in the world.
Very high quality deposit. I think that the anticipation around the deposit will increase once the certainty of on time, on budget occurs. And for sophisticated investors, it's going to be more than on time, on budget. You're going to need on time, on budget nameplate capacity. The other stock that you mentioned, the hard rock deposit, the Equinox deposit, I think is a fascinating circumstance. Because the last 4 mines that have been opened in Northern Ontario have been way behind schedule and as much as double budget, or in the case of Cote, almost triple budget, the investment community anticipated that hard rock would be a failure too. And the pathway to production at hard rock has presided over a 50% decline in the share price of Equinox. If Equinox delivers on time, on budget completion, which they're almost certain to do, and if they attain nameplate capacity, which I believe they'll be able to do, I've known this team for a long time, I suspect with no increase in the gold price, Equinox doubles because the objections to owning the stock disappear. That's a fairly unchallenged thesis.
Yeah, I don't think anything's priced into the Equinox Gold stock yet, or the gold stream that Sandstorm Gold has. I was looking actually at the Greenstone deposit. I mean, they have a lot of really good growth plans, but they're waiting for the mine to become cash flow positive in the next 6 months. Looks like they have an underground mine. They have another potential deposit that can be trucked there. There's a lot of good exploration drilling targets. I mean, this mine could potentially be a long district for many, many years, way longer than the 14 years of reserves.
And the truth is, they don't need to do any of that in order to double the share price. All they need to do is attain nameplate capacity.
Well, I'm talking long-term potential for Greenstone. Do you think it could get up there with maybe Canadian Malartic or Detour Lake?
No, I don't. I think there's more there than is in the reserve or resource statement, but I see hard rock as a high-quality tier 2 deposit. I see Malartic and Detour as tier 1 deposits.
Even though the costs for Greenstone are going to be below 900 an ounce, at least that was the projected cost.
Yeah, no, I don't have any trouble with mine site costs in the near term being under 1,000. What I have trouble with is seeing Greenstone become a 10 million ounce deposit.
Those are pretty rare, right? There's not many of those to find anymore.
I mean, Malartic and Detour are both deposits that have in excess of 10 million ounces in recoverable reserves and resources. Those are scarce beasts.
And Agnico owns both now.
That's correct. That is correct.
Yeah, again, not even Newmont Mining and Barrick Gold have anything that close.
Agnico relative to its peers is probably premium priced. The reason that it's premium priced is it has premium assets, and they've been superb capital allocators, asset allocators. I've known them for a very long time. I think I've seen them make maybe, pardon me, I got to kill this call. I think I've seen them make maybe 2 mistakes in 20 starts. So they deserve a premium price.
So you don't think any of the companies like EMX Royalty or SSR, they're not being discounted extra because of exposure to like royalties or mines in Turkey? Then you think that's just maybe a lack of long-term reserves at some of the mines?
That's a very broad question. I think that EMX does get punished for political risk because they operate in a whole bunch of places. But I think they get punished more because there was a big seller, SSR. And people don't pay too much attention to the story, which requires them to think. They pay attention to momentum, which causes them to feel. People think because EMX went down that it's bad. It's interesting that if you think something is worth $2 and you see it at $1, you're afraid to buy it. Whereas if you see it at $3, you're happy to buy it. I think that's what's happened to EMX. With regards to political risk, my own belief, Jason, is that every jurisdiction in the world is bad. There are no good political jurisdictions. What you need to consider is what price you are paying for political risk. The worst experience I personally have ever had with political risk was in California. And the best jurisdiction in the world for me, cash in, cash out, was Congo. Is Congo more politically risky jurisdiction than California? Yes, but it's priced very, very, very differently. Or making it hit closer to home for some of your listeners, I wouldn't invest in the province of British Columbia outside the traditional territories of the Tahltan and the Nisga'a. I just wouldn't do it. I think the political risks in British Columbia are very, very, very high. But people that look like you and I somehow believe that's money that's stolen from them by Caucasians in English, according to the rule of law through the legislature, is less gone than it is in other cultures where the theft or the tax or the royalty occurs in a language other than our own with people whose complexion is different.
Well, being a contrarian requires discipline, and you have to look at risk and reward and valuation. So you brought up the Congo. I actually was in 2008 financial crisis. I was buying shares of Lundin Mining at 30 cents because I saw that they had the partnership with Freeport-McMoRan, and the mine was almost done. That massive copper mine, Tango Fugarome, in the Democratic Republic of Congo. And I was just reading all the comments on the message boards. Companies going bankrupt. The military's going to seize the mine. And I was like, well, at 30 cents, I'm going to buy 500 shares. I didn't put like my whole life savings in it, but risk reward was an excellent speculation, and then the shares went to $5 about 18 months later.
Jason, in particular, at that point in time, I was a very large shareholder. At that particular time, the company had 30 cents a share cash in it, and it was selling for 30 cents a share. So you were getting Tanke Fungarumi and the Lundins for free. The shares were selling at cash. Now, one of two things could happen. Either the company could go broke, in which case you'd lose 30 cents, or the company wouldn't go broke. They'd be able to hang on, in which case you'd get $3 or $4 or $5. Ultimately, you'll recall that company got taken out first by Lundin Mining, and then, of course, on-sold to the Chinese. And the total return, had you hung on, was $15, which from 30 cents is a wonderful outcome.
Well, I had just gotten into resource investing back then. I was researching this with the bank balance and inflation. I was researching the history of the Lundin family. I mean, they have a track record, a very successful one of doing stuff like this. Look what they did with Fruta del Norte in Ecuador. I mean, there was a lot of people that thought Ecuador would never approve mines, and now it's one of the world's top gold mines in terms of profit margins and free cash flow.
A superb mine, and a mine where the risk extended beyond Ecuador. There were several different mineralized domains there, which meant that you were mining a different style of rock in several different lobes of the deposit, which means that you have to process them differently from each other, which is very complex. At the same time, there were complex, which is a euphemism for lousy, ground conditions. So it was a very, very difficult mine to build. And the Lundin family and their contractors, the Gignac family, did an absolutely superb job there. My hope is, we were talking earlier about consolidation. My hope is now that Lundin Gold, having really truly put Fruta del Norte to bed, buys another development stage asset and does it again. These guys are superb mine builders and superb operators. And by the way, there is nobody in the world that I know of that is better at emerging market, local community sociology than the Lundins.
So I want to ask you about the situation in Panama with First Quantum, the copper miner, and Franco Nevada. The market just decided to write off the asset down to zero for Franco Nevada, but it looks like there was actually a settlement, 2 years ago that was reasonable because the original royalty agreement, I think, was in 1996 or something along those lines, which was seemed to be not really fair for the government, that the mining company got like ridiculous terms. And then there was a renegotiation 2 years ago, but then looks like all the protests and stuff, the government caved. Do you think that there's going to be a settlement there, and that the punishment that Franco Nevada shares, it's unfairly cheap right now?
Well, let's look at Franco Nevada without a recovery. Let's just look at the arithmetic. An asset which was, I think, 16% of net asset value ostensibly went away, and the share price declined by 40%. So this is simple arithmetic. You had a dollar bill, somebody took 15 cents of it, and the rest of it is selling for 60 cents. This is just straight math, right? Then you get to your original question. The original concession terms, relative to the affairs of Panama at the time that they signed the agreement, were very fair. Panama was a basket case. Panama changed the concession terms retroactively. In other words, said, we lied, things are different, we want more. And the industry went along with it 2 years ago, but they went along with it subject to international arbitration. That mine has seen $8 billion spent on it. So if the nationalization holds, the Panamanians will be liable to First Quantum and Franco Nevada for some substantial portion of $8 billion, which is about $8 billion more than the Panamanians can afford to pay. Separate and apart from that, the mine was something like 7% of Panama's GDP and over 25% of export earnings. My suspicion is that while a settlement won't occur quickly, a settlement will occur, particularly given now that the Panamanian authorities are beginning to prosecute some of the protesters. I think they're setting the stage for another renegotiation. So I suspect that there will be a renegotiation in lieu of a settlement. I suspect that it'll occur in the 1 to 2 year time frame, which means that the amount of time to resolution is beyond the amount of time which most speculators allocate to a position. Most speculators seem to have trauma holding stock over a long weekend, and benefiting from this circumstance might take 2 years. There are recurring rumors that a transaction between Barrick and First Quantum might occur. I can see why the First Quantum managers wouldn't want to see this occur, but there is nobody in the world who is better at achieving political reconciliation around large deposits than Mark Bristow. He's done it in Mali. He did it in Tanzania. He just did it in Pakistan. Probably the best outcome for investors would be to see a transaction where First Quantum became part of Barrick.
And Franco Nevada sitting around $105 a share. So the share's been in a trading range for a while, basically stuck until there's some type of resolution. I hear a lot of the bears for Franco Nevada say that they have no more growth now, but didn't they pay for a lot of royalties and streams that are going to be coming online in late 2024 and 2025, right? So there is growth that they paid for. It's just it hasn't kicked in yet. So the narrative now, while the share price is weak, is that they don't have any growth.
What you say is true. What the market ignores, too, is that growth that hasn't occurred, in the sense that both Barrick and Wheaton, but nobody else, have the balance sheet flexibility to participate in very large financings. And there are 6 or 7 very large financings out there to do. When I say large financings, I'm talking about $5 to $10 billion financings. there are only two companies in the world that have the ability to write $1.5, $2, or $3 billion checks, and those are Wheaton and Franco. And what the industry, or at least what the financiers haven't taken into account, is the optionality around both Franco and Wheaton being able to participate in very large financings at a point in time where capital is scarce, and where they can generate absolutely superior returns on capital employed.
Are you talking about gold or silver byproduct streams, say on a copper mine?
There are those. There are also some large mines where some portion of the ownership will likely change because part of that mine will be bought by a host government that doesn't have any money. There is also a sovereign, which is a large royalty holder, which is looking to generate some cash without selling the royalties, which is to say they would like to entertain the offer of a stream on part of their royalty production. These are not transactions that mortals can participate in. These are transactions that are there waiting to be done that require very large balance sheet capabilities, which both Franco and Wheaton, or probably more likely given the scale of the transaction, Franco and Wheaton cooperate on.
Okay, so those would be syndicated agreements. I know syndicated agreements have been discussed for 10 years, but we haven't really seen any yet where Franco and Wheaton or Royal Gold all participate in a co-financing. We haven't really seen one of those ones yet.
They haven't had to. We have a circumstance now where there are any number of copper deposits that are $5 or $6 or $7 or $10 billion in construction. There are also, as I say, these privatization opportunities where societies are seeing the upside in controlling part of their mineral wealth, but they're bound by existing contracts not to retroactively change the fiscal terms. The way that that could occur, given the relatively low valuation of these deposits relative to their net present value, would be to finance either at the entity level or at the buyer's level. And that would likely include the sale of a stream for all or part of the equity component.
And let me add too, on the demand side for copper, I think the market hasn't figured this out yet, that for all these green energy technologies and electrical grid upgrades, electric vehicles, and even artificial intelligence, there is a lot more copper required, a lot more electricity required in order to use, say, something like artificial intelligence, because you have to build more data centers, you have to upgrade electrical grids, electric vehicles. If you have nuclear power plants, you still have to have upgraded power lines and all these other things. I was looking at projections that if artificial intelligence for a higher end case, if artificial intelligence catches on in the next like 6 or 7 years, that global electricity demand could actually double in the next 6 or 7 years with artificial intelligence investments. That would be a lot more copper.
I think that even without artificial intelligence, you and I look at rich people's copper demand, artificial intelligence, electric vehicles. There are 1 billion people on Earth with no access to primary electricity at all. There are another 2 billion people on Earth that have access to unaffordable or intermittent electricity. And because of politics, the grid in the Western world hasn't seen substantial investment for 80 years. Increasingly, too, the electorate favors inefficient, intermittent forms of energy, which require an addressable grid. What I'm trying to say is that even without artificial intelligence, even without a Tesla in every garage, demand for grid upgrades and the general demands of the electrification of the global economy means that we're going to be using much more copper in the 5 to 10 year time frame than we're using now. What you say with regard to the adoption of AI is, from my point of view, really the icing on the cake.
Yeah, I think the average person just thinks like artificial intelligence, oh, it's ChatGPT, oh, it's a software program.
Right.
Well, that's only one component. You have to stack all these technologies. You have to build like data centers. So that's tons more electricity usage, tons of more data centers. So you're building out all the infrastructure for artificial intelligence. It's not just a software program. You have to, the artificial intelligence programs draw on way more data usage. So,
No, correct. And to the extent that the voters decide that they want to operate on wind and solar, you have to get that power from where it's generated, where, for instance, the wind blows and people don't want to live, to where they do want to live and the power is consumed. There is a massive, massive grid upgrade to make the grid addressable and transferable that has to occur. And all that requires a ton, a ton, that's the wrong phrase, a lot of copper.
well, even if you're building nuclear power plants, you still have to upgrade all the electrical plugins. So if it's your home, I mean, the average person doesn't understand. So like, oh, I want an electric vehicle. It's like, well, if you want to rapid charge at your house, you have to spend thousands of dollars on the new copper wiring and stuff so you can get a supercharged plug-in.
And if you're going to build that power plant in Hanford, Washington, or somewhere like that where you can build it, Sheridan, Wyoming, you have to get the power from the power plant to California or someplace where you're going to use the power. What you say, separate and apart from the details, is very true. What's equally true is that humankind has underinvested in every aspect of copper production for 30 years. On a global basis, we consume the equivalent of one Bingham Canyon every year. And we are not replacing one Bingham Canyon a year. So in addition to looking at the demand side for copper, you have to look at the supply side, where decades of underinvestment are coming home to roost. That's one of the reasons why I think that people don't understand the transactional optionality in the very large streaming companies. I think that transactions are there to do in the copper space that will require quasi-equity in the form of streams.
Yeah, I agree. I think there's going to be a lot of opportunities. We're going to need a lot more copper. The narrative out there for a lot of people, a lot of hedge fund managers that are short-term oriented, focused on short-term trading, is that there's going to be a global recession or depression and that China's housing bubble is going to cause copper to collapse. Well, guess what? Chinese copper demand, shockingly, actually grew in 2023 despite their housing bubble because they did electrical upgrades and they were installing more advanced technologies and building data centers. So I saw an interview with the CEO of Freeport-McMoRan Copper and Gold, and he said, and he showed like some of the numbers, that Chinese copper demand shockingly grew in 2023 despite their housing bubble collapsing.
I'm not undisposed to the argument that we have a recession coming. With the caveat that I'm no economist. I joke that Doug Casey and I, between us, have correctly forecast 17 of the last 3 recessions. And what I've learned in 50 years of investing in resources is that if you have a recession, while it scares the hell out of you when it's occurring, that the aftermath is unchanged. A wonderful example of that would be to look at 60 years of stock charts for Berkshire Hathaway. In 60 years, that company has, in 4 different 18-month periods, fallen in price by half. And if you look at a 60-year stock chart, you can't see the declines. The point of all of that is that if you have investing horizons that are long enough to be realistic in natural resources, a recession postpones rather than eliminates the certainty that over time you have a supply-demand squeeze in the copper business. Warren Buffett famously says, with regards to a stock, 2 tests of quality. The first is that you shouldn't be willing to buy a share if you wouldn't be willing if you were able to buy every share of the company at that same price per share. In other words, you buy the company, not the stock. More tellingly, I think for most speculators, he said that you shouldn't buy a share if you weren't certain enough about the company that you wouldn't be delighted to see it fall 30% in price the month after you bought it, so that you could allocate more capital with the same amount of work. That's a tough test. And by the way, unfortunately, I've been tested by it many times. But I think that puts the recession in its context. We don't know if one's going to happen. So perhaps what one does is decide what allocation, what percentage of their portfolio they'd like to see in the copper business, And if they feel uncomfortable with the economy, understanding that nobody has a crystal ball, perhaps they take a half a position now. And after a reasonable time frame, particularly if we do see a recession and the economy and copper stocks fall, then they deploy the other half.
Well,
What
I think
I've
if they're
what I've learned in my life is that being out of a market where my success was inevitable because I was afraid of some extraneous event was a mistake.
Well, crashes create opportunities, and then you can get, if you have cash, like you said earlier, optionality, you can get deeply discounted. You have to be contrarian, though, and that requires discipline. Most people don't want to buy when there's blood on the streets, when some of these shares that were, they're 30, 40, 50% off, all of a sudden people panic. So a lot of the average person is probably going to sell, or they're not going to buy. They're not going to run the financial numbers like you. But I think there's opportunities there. We've seen this with Franco Nevada and Wheaton Precious Metals. They've went in and bought gold or silver byproduct streams when there's
Correct.
crashes. I mean, Franco and Wheaton Precious Metals and Royal Gold grew enormously during the
Right.
gold and silver bear market from 2011 to 2018. They were buying tons and tons of byproduct streams, taking advantage of miners with bad balance sheets.
And the circumstance that we see today, with the certainty of large capital expenditures over the next 5 to 7 years time frame, and the uncertainty as to who might supply that capital, makes a strong argument for the transactional optionality of both Franco and Wheaton.
I want to ask you about Platreef. Do you think that that's going to be the world's best platinum group metal mine as it comes online in the next 12 to 18 months?
I'm not sure it'll come online in the next 12 to 18 months. I think Robert is proceeding at a prudent pace, given the fact that it's likely that both nickel and PGM prices continue lower, at least for the duration of hostility between Russia and the Ukraine, or at least for as long as Russia has to dishoard platinum and PGMs. And I'm not sure that it will be the finest mine in the world. Being finer than something like Mokopane is a tough challenge. But what I think happens is if you look at the valuation assigned to the Platreef within Ivanhoe, I would suggest to you that the market capitalization of Ivanhoe discounts the Congolese assets and Kapushi, but that you get Platreef for free. And that's a very good price. This is an okay nickel mine, but it becomes a very, very good co-product mine if you add the PGMs plus gold back into the nickel production. I think that your time frame may be compressed. I think that Robert is proceeding deliberately rather than with all due haste. And I think he's wise to do that.
So they didn't hedge then the base metal, the nickel prices or anything like that in the short term?
Nope. Nope. Nor, I think, do they have complete accommodation from the South African government with regards to fiscal stability, power access, and water access. I think those are all transactions to be done.
That's interesting because the Ivanhoe mine shares, I mean, I haven't looked at the chart in the last couple of weeks, but the shares were actually doing very, very well the last 6 months.
Oh, you'll note they haven't made a lot of noise about it, but you'll note that it would appear that they have a third copper discovery in Congo, this time on 100% owned land. The current share price, I think, factors in Kakula, which is in production, Kamoa, which is under construction, and the fact that both of those deposits are in effect 40% owned by Ivanhoe. The new discovery, if it turns out to be of reasonable tenor, which I think it will be, is on 100% owned land. And that makes a big difference, or could make a big difference. It's interesting that you have a discovery that can make a difference to a company with a market cap the size of Ivanhoe's.
They have a lot of good base metal mines there. I mean, the Platinum Group mine looks really good. The risk is South Africa, but the mine itself with the grades and all the different phases they have planned. I mean, it's going to take years though for some of those phases. Looks like they're going to be growing production through 2030 or longer.
I think that's absolutely true. They are talking about recoverable reserves of precious metals of in excess of 80 million ounces. It's quite a deposit. And as you say, the fact that it's going to be a large scale underground mine means that it will be producing free cash for Ivanhoe shareholders or somebody's shareholders after your time on Earth, never mind after my time on Earth.
Well, I think the industrial end users for platinum and palladium, they're going to want sources outside of Russia. So there's not many countries that have reliable platinum and palladium sources outside of Russia because Russia is such a large supplier.
And of course, those same buyers who we talk to all the time want supplies outside of South Africa too.
Yeah, but Zimbabwe is the other major producer, right? So I mean, like most of your choices are what, Russia, Zimbabwe, or South Africa.
Well, what it means for me personally is in terms of PGM and nickel exploration, I'm looking to Brazil. I'm looking to other terrains with large Archean or Proterozoic terrains with large existing mafic or ultramafic endowments. Not saying that we're going to be successful in financing companies exploring in those places, but we have certainly heard from the OEMs and JOCMEC, even Glencore, the metal traders, that there would be a huge premium on tier one deposits outside of South Africa, Zimbabwe, and Russia, were they to occur.
Sounds good in theory. I mean, we'll see. It doesn't look like there's anything near term, though.
No, there isn't anything near term. There are a couple of explorers, which I think are doing very well, but they're a long way from having proven up a tier one deposit, which is what it would take.
So I want to transition now to uranium. I just pulled up a chart of the uranium spot price, and the last 12 months, it's gone absolutely bonkers. It was below $50 around 12 months ago. It's at $103 a pound today. Do you think this is sustainable, and do you think that the uranium price could go higher?
If you give me the use of the word could, I can sell you anything. It doesn't have to go up. I would suggest to you that the incentive price for new construction is about 80. What speculators need to understand is, I guess, three things. The first thing is that increasingly smaller volumes of uranium are sold in the spot market. So the spot market is becoming useful as a measure of sentiment rather than the uranium price. More transactions are taking place on the term market. The term market is opaque and people can't see it, so they don't pay attention to it. The second thing is, could the spot market go higher? Yes, because although the incentive price is lower than the spot price, the incentive price won't bring new production online for years. In the case of shut-in Cameco and Kazatomprom production, probably not within 2 years. In the case of new mine construction, things like NextGen, probably not for 5 to 7 years. In the interim, anything could happen. What's important for speculators to realize is that the spot price, other than sentiment, is becoming a floating abstraction because that's not where pounds are being sold. And what's unique about uranium, what could really drive the market for the uranium equities in the next 5 years, is with the coming prominence of the term market, and with the fact that new build reactors are often forced by their lenders to lock in supplies in the term market for long enough to amortize the loan, that uranium producers will, in the next 2 years, have the highest visibility of future sales revenues of any resource company. Gold, unless it's sold by way of a stream, is priced at spot, and spot changes every nanosecond. Uranium companies are entering into contracts that set a floor price over 10 years with escalators according to certain conditions, which means that the revenue line of uranium producers in the next 10 to 15 years can be predicted with much more certainty than in any other commodity on the planet. which means theoretically that uranium mines could be financed with more certainty and hence at lower capital costs than any other commodity on the planet. And I don't think that uranium speculators or uranium investors, for the most part, have factored into their own minds the importance of the term market and the importance of both the certainty and the visibility of revenues in the 10-year time frame. I think these are true game changers.
It also looks like Kazatomprom's not going to be increasing production rapidly and flooding the market with new supply like they were doing for 6 or 7 years post Fukushima during the bear market. They actually announced recently that they're actually having some production problems and they're not going to hit their production guidance.
I think that's true. What Kazatomprom guided publicly 18 months ago was that they wouldn't restart the suspended projects, until they had enough products sold forward that they were guaranteed of receiving a reasonable return on capital employed, and until they had most of that product sold forward at the incentive price for new production. Kazatomprom said that selling pounds for $40 a pound when global production was in a deficit and when the incentive price of new production was $75 a pound was the same as stealing $35 a pound from the Kazakh people. A pretty profound statement. The second thing that happened to Kazatomprom is that many people assumed that the process of starting up or restarting an ISR deposit was pretty straightforward. You just add water. Well, it turns out it's fairly complex. It's like a water flood. The injection of water has to be engineered so that the water advances across the roll front in a consistent and ratable fashion. Easy to talk about, a little bit tougher to do. And so both technology and market discipline have combined to create a circumstance where the 15 million pounds a year of shut-in production that Kazatomprom had, that everybody, myself included, thought would occur as soon as you had reasonable incentive prices, is going to be delayed. An awful lot of it is going to have to do with Kazatomprom's ability to negotiate with various takers, but in particular China General Nuclear, sufficient term agreements.
So in the near term, potential new supply, there's only a few small producers like Uranium Energy Corp and a few others restarting. Is that it?
Yeah, that's right. The big guns are Cameco and Kazatomprom, and it would appear that you aren't going to see substantial production increases from them for at least 18 months and perhaps 2 years.
Interesting.
Boss Energy's coming on. There's some odds and sods production that's coming on, but even the production that you see from Uranium Energy, where the construction around New Start is imminent, you aren't going to see substantial production out of them for a couple of years.
I'm also cautiously optimistic about some of the statements that have been coming out the last couple of months from the United Kingdom about wanting to either restart or build new nuclear power plants, and I think over $500 million in funding. And then COP28. Look at the electricity prices, what has happened in the European Union during the last 2 or 3 years with the cost of electricity, manufacturers threatening to leave some of the areas, small businesses shutting down. I think they realize that they need much more stable, cheaper baseload, and the only one that mathematically rationally works is nuclear power consistently.
Absolutely, positively correct.
I mean, look, Germany had to bail out Siemens wind and solar division. So I think they're going to start even thinking about restarting or building new nuclear power plants too.
I'm laughing because my favorite meme, if it is a meme, is the Germans knocking down a wind farm to expand an open-cut lignite coal mine. That tells you almost everything you need to know about German energy policy.
So it looks like uranium and nuclear power is in a sweet spot, at least for the next couple of years. It doesn't look like any potential new supply could come and just drastically flood the market. And we'll see if the politicians, they actually allocate the capital. There could be some big demand drivers then for nuclear power and uranium too.
Well, I need to say, Jason, that with regards to nuclear power, when you and I were talking about it 2 years ago, the stocks were cheap. I think with regards to the uranium juniors, the easy money has been made. You know, a basket of those juniors who exhibited at our uranium boot camp 2 years ago, that basket of stocks has tripled. Any rational speculator, when his portfolio has gone from being hated to being tolerated or even loved, takes some money off the table. And I've sold enough of my uranium juniors that I no longer have a cost basis in any of those stocks. I happen to believe that over the next 5 years, because of the transition of the market from a spot market to a term market, that the big money is ahead of us. But it's not ahead of us for the whole sector. There are 80-something uranium juniors, probably only 12 of whom are viable. I think if you buy the sector for the next 5 years, it's not going to matter about the structure because most of the juniors don't have any uranium. You have to focus on those companies who will benefit from the structural changes, and you have to understand in your own mind those structural changes. That means, because it requires work, thinking as opposed to feeling, that most speculators won't make any money in the space.
Well, plus, Rick, and you know this better than I do, that all the shell companies, because uranium's the hot flavor right now for commodities, all the shell companies in Vancouver, the juniors, they're going to transition to uranium now, and they're going to start marketing uranium plays.
Very good point. In the early part of the decade of the 2000s, well, coming into that bull market for uranium, there were 5 uranium juniors that had survived a 20-year bear market. There were probably between 12 and 15 teams that were competent to look for uranium. So the probability that your uranium junior had a good team was a function of dividing the number of aspirants, 5, by the number of teams, 15. Yielded you a very high probability of a good team. At the top of the boom in 2008, the number of aspirants, which is to say uranium juniors, was 500. And the number of teams was unchanged, which means that the arithmetic became substantially worse and will become substantially worse as uranium itself becomes more popular.
Oh, I think you're going to see name changes. I think you're going to see like crypto miners or gold juniors. You're going to just see them change the name of the shell company to something uranium soon.
Look at how many people went into the lithium business. They had to Google it first to find out how to spell it. And then they changed the name of their company from XYZ Gold or XYZ Cannabis to XYZ Lithium with the same result.
So I know you go on vacations to South America and Argentina. Do you think that Malay is going to be good for mining investment and oil and natural gas investment for foreigners?
I suspect he'll probably fail in Argentina. I say that with a heavy heart. He is the best politician of my lifetime, perhaps faint praise. I don't think that Argentina is ready to develop an apolitical future. In Argentina, politics is a full contact sport, and Argentines see the role of government as being one of stealing from their neighbors while protecting them from their neighbors' theft. And I think that the election of Milei was very much a protest vote against the Peronistas, rather than a vote for true change. I would love to be wrong, Jason. My experience in Argentina as an investor, which goes back 3 decades, would show it to be an unusually politicized, which is a polite way of saying an unusually corrupt society.
Yeah, we'll see how much of his policies he gets to implement. It would be nice if he kind of copied what Quebec has done with incentivizing mining companies to make investments there and incentivizing exploration drilling. I think if he allowed for foreigners to have private property rights, I know a lot of the mining companies operating there, don't they have to set up like offshore shell companies or something for foreign currency transactions? Because in the past, Argentinian government would try to steal the money in the banks.
You said a lot of things there. The answer to that is broadly yes. The way that you sell a deposit if you succeed in Argentina is that you set up a shell, generally in the British Virgin Islands, that owns the shares of the Argentine asset. And then rather than sell the Argentine asset and invoke transactional taxes in Argentina, you sell the shares of the BVI company and avoid tax in Argentina. It is also true that Argentina has had draconian currency controls to the extent that when I was operating in the oil and gas business in Argentina, because we couldn't repatriate the revenues from our oil and gas business, which was, by the way, highly profitable, we had to use those revenues to buy shares of YPF, which we could do because we were an oil company. We had then to transport the shares physically to Uruguay, sell them, remit the money from the sale to Calgary, and then remit the money from Calgary to Argentina to pay the operating expenses. Truly insane circumstance that eventually caused us just to sell those assets to some Argentines who could deal with taxes in a more traditional Argentine fashion.
That sounds like endless migraines.
Oh, Jesus, it was unbelievable. I dispute what you said with regards to incentives. I think what Milei is all about is end incentives. I don't want him to create financial incentives, government-sponsored incentives for the mining industry. I want him to abolish the mines ministry. I want him to create a circumstance where the government doesn't get in his way. I don't want any government nexus. I don't want to steal money from other citizens the way that Quebec does to subsidize me. In classical sense, my answer to all of that is laissez-nous faire. Leave me alone.
I wasn't aware Quebec was doing wealth redistribution like that. I just thought that they were doing that to get investment in jobs so they can maybe get some tax revenues later.
They are. They're trying to steal from the Quebec's taxpayer in order to provide jobs to certain ridings that reelect them. In other words, they're picking winners and losers. And from my experience, the government mantra is if it makes money, if it's successful, tax it. If it fails, subsidize it, which I don't think is a great prescription for an economy.
Well, in a perfect libertarian world, government would be smaller or not exist, and there would be little to no taxes. But unfortunately, that's not how people vote in governments and bureaucrats. Politicians and bureaucrats like to do things.
Agreed.
So in the next couple of years, Rick, do you see a lot of mergers and acquisitions then because of cost of capital for a lot of different commodities industries?
If the markets don't rebound, if the share prices don't go up, if the cost of capital doesn't increase, you're going to see a ton of mergers, which I think is a very good thing.
I think it's going to be out of necessity because of cost of capital right now. I mean, I'm listening to conference calls for some of these companies, and no one saw that interest rates were going to be raised that quickly and stay at these levels.
Your lips to God's ears. The mining industry has way too many management teams. It has way too much G&A relative to AUM or free cash flow. The best way to eliminate G&A is for the really inefficient companies to die and for the marginally efficient companies to merge.
I think we need to see that in the royalty and streaming companies too. It's already started in the last couple of years. I think it's going to pick up because, like you said, the future for financing some of these base metal mines, the copper mines, these are going to be massive projects. And there's no way that, say, like a small cap royalty and streaming company or mid-tier can handle all this stuff. I think there's going to have to be combination deals going forward.
I think there will be combination deals, and I think that the royalty and streaming market will bifurcate. You'll have one group of successful companies that can write the $5 to $25 million check. You'll have another group of companies that are going to be able to compete in syndicate or alone in the $250 million check. And you're not going to see a lot of room in the middle. The merger between Mavericks and Triple Flag, I think, is an example of a fantastic merger. The resultant company operates twice the assets with the same G&A that they operated one of the assets. They have larger scope, larger scale, larger opportunity for deployment, and as a consequence of having larger mass, more trading volume, and hence ultimately a lower cost of capital. That's absolutely the recipe for the future of the entire mining industry, including the royalty and streaming space.
And the new CEO that Osisko Gold Royalty, the board just hired, I mean, his resume includes selling, I think, 3 or 4 mining companies if you look it up on LinkedIn. So it looks like that's the route that they're deciding to go to.
It would appear that Osisko Royalty, it would appear that the owners of Osisko Royalty, the shareholders, have decided that it not be a holding company and a merchant bank for the rest of the Osisko group. If that's true, if they sell off their equity stakes in the Osisko companies and redeploy that money into royalty and streaming, and or decide to either sell Osisko Royalty or buy a different royalty company and bulk up in the business that those shareholders like, I think that augurs for very good things for Osisko Royalty.
Well, they own one great royalty, right? It's Canadian Malartic. I would argue the rest of their portfolio is kind of mediocre, but that one royalty, I mean, that would be something. If I'm Franco Nevada, that's the one I want to own. The rest of the stuff I don't want.
And I think, well, frankly, I like Eleanor better than you might. But I think either Franco or Wheaton, this is speculative, could buy Osisko, sell off the assets that are to them second tier that wouldn't be second tier, to a Mavericks or somebody like that, and greatly reduce the cost of acquiring the assets or asset that they wanted to keep.
We're in agreement, actually. I was actually suggesting that to Adrian Day. Adrian Day said Franco shouldn't sell any of their shares at the current valuation. I was like, no, they should go and try to get that Canadian Malartic royalty and then just hire an investment bank in the US or Canada and sell off the other parts they don't want to recoup the transaction costs for getting that Malartic royalty.
Purely a function of price.
Well, I mean, like these precious metal royalty and streaming companies, I think they should, sell the stuff they don't want and be more efficient and focus on, Franco only wants to own the really, really good royalties and streams, so they don't need some of the smaller ones. So if they want to move the needle, I mean, Malartic would be, other than maybe the Young Davidson one from Triple Flag, but that's not as good as the Malartic one.
I would agree. As I say, I have a different opinion of Eleanor than you.
Well, I really enjoyed our discussion today, Rick. I think we could talk for another hour or two. I want to thank you so much for your time. If my listeners want to check out Roll Investment Media, also, when's your next conference?
Well, thank you for all of that. The first commercial would be, if you like what I have to say about natural resources, figure out what I have to say about your resources. Specifically, go to ruleinvestmentmedia.com, list your natural resource stocks, and I'll personally rank them 1 to 10. No obligation, no cost. We have an upcoming boot camp, which is an 8.5-hour long online session about prospect generators and early stage exploration, a really unloved and hence cheap part of the resource equities markets. You can find out about that at Rule Investment Media under boot camps. And of course, we have what I think is either the 29th or the 30th installment of the Natural Resources Investment Symposium, a live and online conference, July 11th through 17th, I think it is, in Boca Raton, Florida. I quite simply believe this is the best retail natural resource investment conference on the planet. Both the boot camp and the live conference come with an absolute gold-plated money-back guarantee. If you pay to attend either or both events and you don't think you got your money's worth, simply email me and I'll give you your money back.
And you had a lot of great speakers too at the Florida event last year. You had Grant Williams, Nomi Prince, Jim Rickards. You had very big names. And
it's getting better this year in terms of executive publishers. Executive sponsors. We have Agora Inc., the largest financial newsletter publisher on the planet. We have the Mining Journal, the foremost industry publisher in the mining business. We hope to announce very soon that we will have the Northern Miner, the most prestigious mining publication in Canada. We have the same range of very high-grade speakers, and dare I say, we have the best range of exhibitors of any conference on the planet, for the simple reason that to be an exhibitor at our conference, you have to be owned in accounts that are managed by us. That doesn't mean, sadly, that every stock that we buy goes up. What it does mean is that we have vetted every exhibitor to the extent that we're willing to own them. At most investment conferences, sadly, the qualification to be an exhibitor is a check that cashes. That's it. At our conference, we have to know you well enough that we've invested our money in you. And because of that confidence that we have in our speakers and our exhibitors, we're the only conference in the world that I know that offers attendees upfront a full gold-plated money-back guarantee.
I may come down to Florida for that one. I'm trying to get a vacation. I was thinking about going to Florida anyway.
I would love to have you down there. Among other things, we're going to have a special room for podcast hosters and media people to interview our exhibitors and our speakers. And you would be welcome to join 20 or so social media outlets and the established press, as an example, the Mining Journal and the Northern Miner at the Boca Raton Conference.
Excellent. Well, I think there's a lot of contrarian value opportunities. I mean, in the short term, as things are with the contrarians, they could keep getting cheaper. So cash is probably, having some cash is probably a good idea. But I think over the next couple of years, I think there will be a lot of good opportunities. And as you always say, Rick, the cure for low prices is low prices. So there will be a bottom in these gold stocks. There will be mergers and acquisitions. It might not be at the valuations that the shareholders of the company getting acquired want, but the combined company may be good. And then the cycle will eventually shift.
I agree with you completely.